Hey, everybody. Thanks for joining us today. Both Bill Mann and I are excited to have you in our inaugural podcast, The New Barbarians. And well, first, before we go into the topic, I want to go into the players here. Bill and I have known each other for the better part of 8 years while I was at Credit Suisse, and Bill was a client at Two Sigma. Touching on my background, for those of you who don't know me, I've been in markets for a little over 35 years, starting as an intern on Solomon's desk in '86, being beaten up like they often did there in the days of Liar's Poker on the new guys, and really got hooked on markets in that environment, how dynamic they were, how there was such a flow of information and really required cross discipline. Since then I've been a portfolio manager, risk manager, a strategist, and now focused on the opportunity of Bitcoin and how it works in a multi-asset portfolio. So that's my background. Bill, why don't you introduce yourself to the crowd here?
Yes, thanks, Mark. My name is Bill Mann. I actually got my start in Wall Street at a company called Arthur Andersen. I was an accountant. And then Arthur Andersen went out of business in 2001, 2002 with the Enron blowup. And subsequently, I continued to become more of an equity and bond analyst in a fundamental research role. And then I was at AIG Financial Products, the unit of AIG that blew up AIG and arguably the financial system in 2008, 2009. And, since then, for the past 15 years, I've been in quantitative research in various roles across risk and alpha generation and, most recently in, AI, machine learning. You kind of named the latest catchphrase, and I've kind of seen it all.
Yep. And that's how I met you, Bill, was when I was at Credit Suisse, working in a division that dealt with leveraging, hedge funds, and then we had data. So we would share some data with our clients that was anonymized and aggregated as sentiment data. And then you and I would also then have discussions about macro factors. Given your experience, you've seen the landscape change over time. Fewer players, a little more concentration. Events change what's important. Our podcast, The New Barbarians, talks about the arc of what makes a titan in that period. We just had Elon pass the $400 trillion mark. Tesla's up, I think, 26% this month, while most every other sector is down. Banks, industrials, digital assets. So can I ask, when you and I talked about doing this podcast, what was the major driver for you? I mean, a little bit how I work, but what really brought you here to what did you want to bring to the game, to the audience?
Sure. I guess, the most obvious thing for me is after I left Two Sigma and struck out on my own as an independent advisor to quants, I thought I knew everything there was to know about data and alt data and all the new things that are out there, but I wasn't up to speed with crypto. And given your focus more recently on that, it's definitely been an area where I've been quite focused and, kind of investing personally. But I think maybe even more on point would be the fact that what we're seeing now is just a different paradigm on Wall Street. And it's not just, data and this quant revolution over the last 10 plus years. I do think that things have changed forever. You can even look at pandemics and crazy things that we've recently seen. But I think it's kind of cool for you and I to bring our experience with the old way of doing things in the context of everything new that's going on.
Nice. Yeah. And Bill and I did come at this just by reconnecting recently on markets and, and macro. And I don't know if we can pull up a slide, because part of what we do is we like to define our terms and tell you what we're going to be talking about for each podcast. And when we talk about the new barbarians, every epoch or every section or segment of time has been punctuated by a problem and an opportunity. And if I was going to show the one graph first, it'd probably be the GDP, debt to GDP graph that we have in the US, I think since like 1939 or so. And coming from the credit side, debt was always a difficult animal to negotiate with. And that's one reason why even the founding fathers brought bankruptcy as one of the first items to bring into the Constitution. Into the Bill of Rights, because they didn't want the sins of the father to bear on the children, and they saw bankruptcy as a critical component for society to recycle assets. And in this graph, you'll notice that World War II, we obviously were deficit funding, and we got up to 120% debt to GDP because we were in a world war, and it was a problem. And we worked off the debt. We grew out of it. Inflation certainly helped reduce the debt load as we inflated out of that in a post environment of growth, post World War II environment of growth, which was spearheaded by a new monetary regime called Bretton Woods. So it was tailwind of money got faster, everyone coordinated. And then the next epoch that we see was something called the petrodollar, when Nixon broke the bargain by depegging gold in that Sunday night massacre in August of 1971. And then I think we're in a new epoch here. We are in a new financial regime where it's a multipolar monetary system where technology will dominate. So, if you had to step back and pick one slide, this is my slide. Again, why? Because I think debt is a difficult animal to negotiate with. And the sovereigns cannot go through bankruptcy like Enron did in 2002 or Lehman did in 2008. That's why we're stuck here. So, you can maybe pull back and show that slide, if you wouldn't mind now, on the Bitcoin, S&P, and 10-year. Just basically, it's a scorecard. So here we brought up an economic concept on the macro side, but now let's look at a scorecard. We all know about returns, and here we have Bitcoin, gold, the S&P, and Treasury ETF, the 7 and 10-year. And I think because we're in this new regime, this is my top-down, and Bill's going to bring up his bottom-up approach to how he solves investment puzzles. My top-down just says you got to be in the right lane or the right escalator that's going up and not the one going down. And right now, I think the bond escalator is the one that will continue to go down, continue to underperform as we remain in an inflationary environment. And you'll see here, Bitcoin's dominated over a 5, 10-year, year-to-date basis. Gold has gone up in value. You'll see, it returned 12% over the past 5 years, 27% this year, year-to-date. And that's up from 8% 10 years ago on a 10-year basis. It's because we're being debased. But you look at bonds, and bonds are just getting obviously hammered. Single-digit midget plus minus zero for the past 10 years. And that's why we think the Milken barbarian is still in the ground. And that's why Elon and technology, the promise of giving more for less, those are the animals that are now the new barbarians at the gate. So that's my missive right now to kick off my top-down macro. And Bill, I don't know if that's a good launching point for you to come in about the kind of tools you've absorbed recently or even over your career to kind of look and poke and prod.
Cool. Thanks, Mark. I guess one thing I will also mention is that Barbarians at the Gate was a book that I read when I was, I think, a sophomore in college. So this is late 90s, 1996, maybe, before even the dot-com bubble. And if we go back that far, I was reading about that as something that took place in the past in the 80s. And then you've brought us all the way back to Bretton Woods and World War II. So um, it's interesting to think about, history repeating itself, or whatever analogy you want to make. Um, but what was most compelling to me about that graph when you showed it to me last spring was, you know, uh, over long periods of time now, crypto and Bitcoin in particular are positive returns. And I remember I think you were showing me another one that was like a rolling 4 year or something, which, basically showed that it's consistently positive. And being a quant, and in particular being a risk quant, all I ever looked at was volatility. And volatility is bad. You want to minimize volatility. You want to diversify your portfolios. Get out your textbook, and that was all I saw. So over the decade that I didn't really get involved, that was why. I was classically trained to hate volatility. It was scary, and I remember when you showed me that graph, and then I finally said, okay, I'm gonna go out on a limb and buy a Bitcoin ETF. So basically that's how long I was out of the market. I regret it, obviously, now. Um, but you know, not only was I trained as a risk manager who hated volatility, and we were scared of rogue traders and things like that back in the day, with more traditional Wall Street. And of course, someday we'll get to my experience at AIG, where we took a pretty big concentrated position in structured credit. Um, Bottoms up, we look at, quants typically, in the equity space, look at a cross section of stocks. So you look at thousands of stocks and try and come up with a price prediction for every single one of them. You construct portfolios in various ways. You actually come up with many different forecasts, and basically throughout this process, you come up with a consolidated way of looking at a single stock forecast for thousands of stocks, and then you send out your orders and you rebalance and you constantly update everything. And that is a bottoms up approach. Even though you're using a lot of compute power and a lot of different statistical techniques, ultimately you are coming up with single stock forecasts. So I struggled to, come up with a fundamental analytical story for crypto. And that, again, it wasn't just volatility that scared me off. It was really just, all right, is this a store of value? And over time, it became increasingly apparent that it was. But I didn't really understand what the fundamental story was for, one coin versus another. And slowly, as I've, come up to speed with all of this, Web3 and sort of the future economy. And I remember when I first learned about smart contracts in Ethereum, I said, oh, okay, now I kind of understand the purpose that these transactions solve in the economy. They make things easier. They might take away counterparty credit risk. And all of that really just means that I started to develop an understanding of the way transactions are done on the chains. And that led me to understand what the fundamental story is with, one coin versus another. And, when I manage my own portfolio of crypto assets now, I basically, like, that's the one requirement. I have to understand what purpose does this blockchain serve, and what is the adoption rate. And then it's not it I remember people talking about market cap, and I was like, what is market cap with like a currency? And I just didn't get it. But the amount of money that's invested on a relative basis in a certain coin is typically going to be a reflection of sentiment around future or current adoption of that technology. And so that's, my bottom up approach is really that. I'm looking at technology by technology. What is it offering today and in the future? And once I understand that, I have a fundamental story, and I can start this bottom up analysis. When it comes to valuing these things, it's also a much different animal. It's not, your typical discounted cash flow analysis. And a lot of it's sentiment based and, technical, like pricing action and things like that. So over time, I do hope to have a full blown, equivalent of what a fundamental quant researcher would do with stocks within this space. But, it's going to take a while to develop that.
So what are some similarities, Bill, that you're looking at from, say, your experience in liquid assets or equities to digital assets, altcoins in particular?
So, yeah, I guess we can just go with Ethereum, for example. So I think that, the smart contract is, basically a technology that provides a service. And I think, again, in many cases, it sort of takes away counterparty credit risk. A contractual agreement that can be executed and settled electronically has a lot of advantages. Once certain criteria are met, the contract delivers. You used to have to actually, wait for your counterparty to agree that, they owed you money or you owed them money. Then you would, back in the day, fax them a confirmation, and that would come back. And then, at settlement, you would have to agree, on the actual price that things were settled. And, over time, a lot of those things were streamlined and, done electronically. But this is actually a purely independent way of boiling that all down to, one, I guess, almost atomic update. The contract settles. Everyone knew what they agreed to ahead of time. Mm-hmm. The technology sort of takes care of all of that headache. So, to compare Ethereum to a new technology, maybe it would be within the tech startups that we became familiar with in the late 90s, early 2000s, whether it was, internet technology that helped enable transactions between customers and suppliers. I would also compare it to, I don't want to say like online brokerages or anything like that, but the new technology that took our old way of doing Wall Street, from pits and, people writing things down with a ballpoint pen to, automating it. Obviously, it takes time to build confidence around those new technologies. I'm sure that a lot of people preferred, screaming out at each other and then trying to write down, the terms of a transaction on a little ticket. But so just Ethereum, for example, and the smart contract specifically, I think is very similar to the tech companies that disrupted entire sectors and subsectors as a result of that. And, maybe the best example would be in Amazon and what it did to bookstores and eventually a lot of other things.
Yep. And, you mentioned the internet and the 99 to kind of 2000 period. People think of the dot-com bust. And yes, there were a bunch of companies that needed to go through bankruptcy and other ones that emerged out of it. As we know, I was on a call earlier this year with a woman named Jennifer Murphy at Runa Digital Assets, who was at Legg Mason with Bill Miller, and then later at a larger asset management firm. And she's been around watching it. She mentions how Bill Miller was one of the few people who entered or put a ticket in for the Google IPO, one of the few institutions, because it was something that people weren't looking at. I remember using Google in the late 90s. One of our analysts was a tech forward gal, and she's like, yeah, you got to use this. I'm like, what is this? How does it work? And we were using it before the IPO. I didn't know about the IPO. I didn't put it into it, and I should have. But we've always had this. TCP/IP was a base layer for HTTPS, and then voice over internet protocol. So I agree with you, and I think it's one of those. The William Gibson quote that I love is that the future's already here. It's just not evenly distributed. And Google was there, but I didn't realize it as an investment.
It's another one I passed on and didn't understand it. And searching, how is that something you can monetize? Well, marketing. I had never, even buying things on the internet back then was, I want something, I go and find the URL, I go and fill out the form, and it was just a lot more work. But over time, they got good at steering us to things that we want, and we don't even know it. And now I'm buying all this stuff on my phone. But yeah, you name the tech IPO that I probably passed on because I just didn't get it. And, maybe Google's the best example of that. Was that 2004 maybe?
Yeah, it was around 3 or 4, I believe. And we have it again. We talk about cognitive biases. The podcast we're doing here, the new Barbarians, is based on people over time who took advantage of the opportunity. With Rockefeller, to Gould, to Carnegie, in the steel, in the steel mills and the building the country. In the old days, or who's the concrete maker that there's a foundation in Tuckahoe, New York, right where I grew up, and there's a foundation, and the family basically provided concrete for the building of our country for about 50 years in the 1900s, and that's how they made their money. So there are layers that are always provided that are used to build, and now, because of our debt load, back to the macro bill before we go back down to more tools, we need to abstract our lives from the analog, from the streets that we walked, into the digital world, because it's faster, it's cheaper, and businesses can't afford to have a storefront anymore. It's just not going to happen. We talked about how to frame this podcast with a mission statement and first principles. And I just love this definition of finance, which is what we're talking about, and how it's a discipline. Love that word. Concerned with the management, creation, and study of money and investments and related resources. That's what we're doing. And right now, what you discovered with Ethereum, and you're applying your same quantitative discipline to this new pool of opportunity. And that's the game. I mean, Elon was not always a guy who built rockets. He was an engineer. He had a discipline. He was an engineer. And now, for all intents and purposes, he's applying to finance as head of Doge or co-head. And God bless him. I don't know how he's going to take care of our deficit with all that debt. Maybe he will find out that he actually does have an Achilles heel. Well, what are some of the tools that you talked about? So, using that sort of segue about Google, what aren't you going to miss now? You and I miss Google. You got involved in digital assets, Bitcoin first. As you know, I'm Bitcoin first because I think the alpha's and the beta there. And there's so many portfolios it needs to be in before people think about something more complex, with a little less integrity, like the altcoins. But where do you see it happening? Like if you were to make a pitch on Ethereum right now, what would it be for a use case? And also from a portfolio standpoint, what kind of characteristics do you think, if any, it has?
Sure. And I guess I'll start off with the story on Bitcoin that was also, again, very compelling to me. So once I was comfortable that it's store of value. It is an asset. It is an asset class. Um, the supply demand story was really all I needed to hear. There's a limited supply of Bitcoin, and the demand is going up. And if, you know, forget about it ever becoming an acceptable reserve asset of central banks or anything that would be the holy grail for Bitcoin owners. Um, there is obviously a demand. There has been for a long time now, and there's limited supply. So it's a pretty easy, microeconomic story around Bitcoin. Um, and then Ethereum again was just the first technology that I gained an understanding around. Um, and so this is the new economy, wiring funds and transferring assets has been inefficient for a very long time. And earlier I was talking about, sending confirmations with paper. And, I remember a really long derivative contract, like the really complex things that we used to do at AIG Financial Products. You could have 100-page document and you had to like feed it through a fax machine, and then the thing would break. And if it's a fax over to Europe, it was a total nightmare. And that's why I will always really love that scene in Office Space when he smashes the fax machine and says, PC load letter. What the F does that mean? Because I used to say that. It used to drive me nuts. Anyway, I digress with, the really old.
These personal experiences, they live deep and they drive us.
They
right?
really do. But, things are still inefficient. I remember when T+3 became T+1 and people talked about straight through processing. And there were a number of tech companies that really did well and ended up being acquired in that space. Just you bring up Elon, PayPal. And these things were disruptive. They were not understood at first. People like me didn't trust the internet. We didn't then trust a company called PayPal. And, I actually remember PayPal used to charge quite a bit to transact over their platform as well, which is just another inefficiency, right? You have this middleman taking the vig for settling a transaction between like two individuals. And then now we have Venmo, and in some ways I look back and I'm like, I can't believe it took that long for someone to solve some of these problems. Like, I just want to send you some money. You used to have to go to the ATM. Actually, you used to have to go to the bank, which needed to be open. And then the ATM at least allowed you to do that on weekends and things. But what I see now with digital currencies and, crypto technology is, giving the ability of businesses, like you say, to avoid having a storefront and all of the fixed costs that go along with, the old brick and mortar operation model, to now having a lot of confidence that these technologies do what they say they're going to do, and that, setting up transactions in the first place is not only efficient, it's more reliable.
So are you seeing folks in your colleagues across the street being involved in digital assets broadly, crypto, trading it from are they doing it as a side job for fun, or are they doing it in their business, or hedge funds involved?
So I would I would say mostly as a side job. And then depending on how risk averse they are, like I have a friend who runs a hedge fund, and when I asked him about crypto, he kind of laughed and said, I only invest in treasuries. And, over the last year, that's been actually yielding something. But, if you're extremely risk averse and you hate volatility, you're not going to do this with your personal account. You're going to, a lot of people believe they've already got enough market risk because of where they work, which I totally understand. You don't feel comfortable investing in real estate or, uncorrelated assets that are, more accepted, well understood. But basically, if you're scared of volatility, you probably won't do this. Once the futures market picked up crypto, I think it at least opened it up to a lot of institutional money. And now with ETFs, I think you're going to see more adoption. And personally, I don't mind if it takes a while for the large quants to really get involved in crypto, because I do think the arbitrage opportunities are, very early innings, and I see a lot of cross asset arbitrage opportunities, for example, and
Yeah.
Crypto focused hedge funds I think are doing that, and they're
Yep.
obviously like FTX and companies like that had what I think are almost like free money types of arbitrage. You trade on one exchange versus another. They have different prices.
Yeah.
It's like a very classic example of arbitrages that go away. But again, if you look at futures versus spot, you can make money sometimes intraday. By the end of the day, you kind of know if you trade two different futures that are going to settle at 4 o'clock, and you lock in a profit, that
Yep.
again kind of seems like free money to me from like the classic arbitrage sense. But it can become more complex if you start looking at volatility trades and trading spot versus futures and the equity versions of things like Bitcoin and Ethereum. I think the mispricing arbitrage opportunities are a lot of times like immaturity a month at the most, but more likely, a day or a couple days.
Yeah, and as you're saying about people's preference for volatility, and a traditional risk manager or quant who's using, not always but often, leverage and a time frame for a collapse of a breakout or mean reversion or another strategy between one or more factors or assets. To have uncertainty, which is what risk is, to have more uncertainty is not good. The carry trade you mentioned is the fattest, biggest trade in crypto. I mean, it's obviously in rates too, with futures and treasuries. That's what blew up on March 9th, I think, and sent the Fed scurrying to then with their like third or fourth intervention, or second or third intervention in 2020. But in digital assets, the one thing that I've seen in our data that we've shown in Bitcoin in particular is that the volatility, and again, I look at volatility as uncertainty, it has more upside vol than downside vol. It has that positive skew, which, as you said, when you said we are all so conditioned to look at risk as always the left tail. Over time, if you have a good strategy, it'll take care of itself. Just avoid risk. And I think we're all created by our own experiences. I think that we are in a market now of no looking back on money printing because of our debt load. And that if you aren't seeking risk, it will find you. So that if you think bonds are safe, well, we just showed that they've returned zero. So your buying power over the last 10 years on average through that ETF, then you're basically giving up buying power as inflation erodes away, and you're left holding a 0 to 2% gain. And like we said with Google, it was a risk. And we missed it. It would have been nice. We would have had a little more feather in our pillow, which we can always use. And so in your experience, did people have that dual view on risk as far as, or did they have another word for it? Opportunity,
So, risk reward is the name of the game, and risk adjusted returns are what we're typically after. So, it occurred to me as you were reflecting that back to me that it's not just volatility is scary, but volatility is risk, and you only get high returns with high risk typically. And what I will say is, quants and statisticians are perfectly comfortable with risk and with volatility if it's something they can look at over longer periods of time and get some expectations about the future. And that's typically what we're doing. We're using the past to predict the future. And so I think the typical playbook with quants would be to go for high vol products. And so when we talk about leverage, you have a nice, well-diversified portfolio that is very predictable volatility for the portfolio, and then you lever that up. So you add volatility just with the leverage, but you have a very clear understanding of what to expect. So that high volatility should be positively skewed. And I think it's good to use these terms because, I think we are always focused on the left tail and just concerned about losing. But when you're convinced you're going to win, statistically, quants are very comfortable with risk. They have the highest leverage typically in the hedge fund space. Yep. And so, personally, I have been trained to think of volatility as risk, but with this asset, and again, it just gets back to what I said earlier.
Or Bill, as risk of loss, to finish the sentence, right?
Yeah, there you go. So it gets back to what convinced me. You showed me the graph, and I was like, you consistently make money even though there's a lot of volatility. Like, that's okay. As long as you're consistently...
Bill, it's bananas. No one still, professionals still don't. This is why I'm spending our own time and money having podcasts like this, because it's the easiest thing I can say, or like it'll stand the test of time. And I loved how you were open to listening to it.
Not always, though. Not always. I think you caught me at the right time and in the right place. Because I did not... I waited too long, obviously.
So on that idea about risk, I deem, back to definitions, risk is uncertainty, period. By definition, it's a variance. It's a variation around an expected mean. That's all risk is. Yeah. And I'm doing two hands because it should have, you have a left and a right side of a mean. And this is I'm going to get into the weeds here on that because part of what we're talking about is high level themes as well as tools and processes to examine today's opportunity. And so here's the one I have for our crowd. You mentioned risk and reward. And risk was, again, implied loss, risk of loss, which, again, we agree is not the appropriate one for Bitcoin and maybe some other digital assets because they have more upside risk. We'll save that conversation for later. Risk of gain, we'll call it. Ooh, who doesn't want to have risk of gain? So when we use a traditional measure like a Sharpe ratio, where it uses just the standard deviation, which is a measure of variance, divided, which divides the return. So if you have a 16% or if you have a 60% volatility and a 60% return, then you have a 1 Sharpe, which is okay for a blunt asset. The S&P doesn't do that too often. More recently it has, but not over long periods of time. And the problem is, if we take that, again, we're in the weeds here, that standard deviation, which is volatility, which is what everyone just assumes is the potential risk of loss, and we break it apart and say, how about we look at the volatility and only gains, or the volatility and only losses, upside or downside volatility. When we do that and we divide the returns by only downside volatility, it's a measure called Sortino ratio, which I have not seen many people spit out in the Bitcoin space or digital assets. And if they do, they'll see that their risk, which is risk of loss, downside, versus their gain, those Sortino ratios are higher than any other asset that you can do right now. So that the reason you're in the game and the reason I got in the game is because it's Google 1997, folks. And people have not realized the power of these assets as an investment tool, which is embedded in their ability to deliver on blockchain's promise of decentralization, security, and scale. Like you said, smart contracts for Ethereum, I think are going to end up on Bitcoin as well as a foundational layer. And that's where we are. These definitions aren't even appreciated by the wirehouses or the major asset managers. BlackRock and Fidelity, I'll say, have pierced the veil. They have stated it. Just people aren't listening.
I think this is all true.
So where does it leave us? Just trade more futures for the home team, Bill? Cash against futures to get that ARB going? Those type of trades, or is it something else?
Yeah, so I think that there is a very good buy and hold argument for, Bitcoin in particular. So again, if you have an IRA account or, just your typical retirement account, I think it does make sense to have an allocation to Bitcoin. It's got a very good supply demand story. Forget about further adoption and anything like that in the future. I think that the demand is growing up and the supply is finite. So I like that as a buy and hold. I also like longer term outlooks for the various coins that have a good fundamental story. So, Ethereum and some of the others, I think, do have a fundamental outlook. It's difficult to think about cash flows and, you're not getting dividends typically, but I think that there is a good fundamental story for, adoption of technology enabled by these different blockchains to be the future value. And so kind of like growth stocks, you don't really expect to get cash flow anytime soon, but you do expect them to generate a lot more earnings and then someday become a mature company that, returns capital to shareholders. So it's a bit of a leap from that perspective, but I do think there's a buy and hold with Bitcoin in particular, and then some of the alternative coins as well. But what really excites me is trying to monetize some of the arbitrage opportunities in the short term. Again, it seems like you can put a trade on, now and get your money back at the end of the day and turn a pretty tidy profit. So that's very exciting to me.
Yep.
Of course, there are unknown risks, and earlier I talked about portfolio risk and diversification being your friend there. There have been plenty of big quant blow up trades where something happened overnight that no one ever could have predicted with history, and everyone gets burned because they over lever low vol trades. So that risk of the unknown has always been there with quants, even with things that they're extremely confident about, given historical statistical analysis. Custody is an issue with crypto. Can a hacker go in and steal all of my Bitcoin? Unfortunately, I think the answer is yes. It's becoming remote. The chances of that happening are becoming more remote now, but there are risks, that bad actors can still take advantage of people. But I think institutional...
Absolutely. That's one of the biggest ones. The fact that this is a bearer asset, that digital assets are bearer assets, that is the opportunity, because there are many. Well, Bitcoin's finite. Other ones are, questionable or have different protocols to handle that, to handle supply, but they're bearer. And, it's not DTC eligible, rip off another certificate.
Right.
Very different.
Anytime you bring that up, but especially this time of year, it's going to make me think of Hans Gruber, who's trying to get into the vault at the Nakatomi Tower to get, I forget how many millions in bearer bonds they had in that.
Hans Gruber.
Yeah.
Was that Die Harder? Which one was that?
Die Hard, the first one, when, the
first
Nakatomi
one. Okay.
Tower. The whole point of that was to get the bearer bonds that were held in that vault. And again, we were talking about millions of dollars, and now I'm sure it's, billions. And this joke has already been made by Austin Powers. But
yes, he did.
So yeah, a bearer asset does mean that, someone can take it away and it's theirs now.
Yep.
But that concept isn't even something that I think a lot of people understand, unless they're big fans of movies like Die Hard.
Nope. So the financial history is really the most recent example is captured in a Die Hard movie, because unless you're talking about Brinks trucks in the old days, with cash and gold and bearer bonds, Hans Gruber, and that had to be is that early 2000s?
I think it was 88 probably.
It was 88, really?
Yeah.
Jeez, I didn't realize it was that long ago. Wow. So no wonder, because that was when bonds were still king. Back to talk about Barbarians at the Gate, the LBO, lords of the LBO, and anointed by Milken, and feted with cash from high coupon bonds that S&Ls were ready to buy. Goodness gracious. It all goes back to the 80s. We're going to have to change our gear and wear other clothes, man.
Yeah.
We're going to have to really get into the...
It was a great decade. And, the Olympics, 1984, Ronald Reagan. I remember seeing Ronald Reagan come to the town I lived in, and got to see him speak. Same year that we saw the Olympic flag, the Olympic torch run through our town.
Run through it?
That was only 40 years ago.
That was, I mean, 80s were transformational, because the 70s, obviously, best decade for music ever in the history of the world. But, that came from strife. There's good stuff that comes from pain, and we had some good music out of the 70s. And we kicked off this by looking at 71 with Nixon breaking the bargain, and giving rise to all these, a new financial frontier. And maybe it's a good point to end the podcast as we go into our cultural milieu, or with movies, music, and money. Ending it here, but I guess Bill, you and I are here to say this is our initial podcast. We're going to be doing more, looking at how this is digital assets, crypto. Again, I'm more focused on Bitcoin, speaking to advisors, because I think it's the fattest, easiest pitch on the planet. What do you want to leave people with as far as what to look at between now and the next podcast, out in the markets, or tools they should kind of adopt to get more familiar with, or also about you and what you're doing at your firm?
Yeah, so I guess I would start off by saying that the 80s kind of started with the Bee Gees and ended with Guns N' Roses. So music got a lot better. Maybe the 70s were the best decade for music, according to some, but certain types of music went away that weren't so great.
That's a good point.
Although yacht rock is very popular now, which still puzzles me. My focus right now is on, bringing quantitative tools to new players. So a lot of what I'm doing is advising, more traditional fundamental and discretionary quants on using some quant process. And I don't want to scare people away by, quantitative technology or quantitative techniques even, because I think what people need to do is just have a more disciplined way of relying on statistics and some math to make better decisions. And it's pretty obvious how that applies in this space, but it has been scary for some time. So I'm trying to demystify quantitative investing a bit, and publishing some research um, on various topics that I think can help people.
Yep. I would suggest that people read your piece. I don't know if it's public yet on LLMs. I'm only a recent, I went heavy about a year ago, stopped back into using AI, whether it be ChatGPT or Claude. But your piece, Bill, is excellent, useful, accessible, practical, and anyone from students to people in the workforce should be looking at that right now, I think.
Yeah, and you can get started with one, but I think you should end up using, 3 or more.
All right. All right. Well, that's going to wrap it up here. Thanks for joining us. Here we are with the new Barbarians, what we can learn from the tech giants that are leading the way into this next regime in finance.
Great. Thanks, Mark. Looking forward to next time.
You bet. Thanks, Bill.